This is ShadowQuant, Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Friday, July 31, 2026, and this is the New York pre-market. Now, let's get into it. The S&P 500 is sitting at $741.69, up 1.68%, while the Nasdaq 100 is surging even harder at $683.55, up 3.3%. But don't let the green candles fool you. The VIX is holding stubbornly at 20.66, signaling that this rally is being driven by short covering, not conviction. And with Apple down nearly 8% and the yield curve flattening to just 45 basis points, we are looking at a market running on fumes and a single headline. Before we dig into the charts, let's look at the schedule. Today is Friday, July 31st. The market is tracking two key data releases. First, the University of Michigan Consumer Sentiment. Second, the Employment Cost Index. These figures will tell us if the labor market's cooling is turning into a wage price spiral concern or just a normalization.
On the sentiment print, watch the reaction in the dollar and bonds more than the equities. If sentiment dips, it might actually help the rate cut thesis, which would ironically boost that tech rally. If it spikes, we get a double whammy with the ECB and Fed looming. Keep an eye on the 10-year yield. If it ticks up on strong sentiment, the tech rally hits a wall.
Here is the snapshot as of 9:27 ET. The S&P 500, SPY, is at $741.69, testing the July 30 high of $742.45. The Nasdaq, QQQ, is at $683.55, right up against its own resistance at $685.12. The Dow Diamonds is at $521.51, up 1.18%, and the Russell 2000, IWM, is at $292.59, up 1.39%.
Let's look at the SPY tape. We are at $741.69, literally touching the July 30 intraday high of $742.45. The volume profile here is thinning out as we approach noon ET. If we clear $742.45 with volume, the next technical node is the 10-day high at $750.02. But watch the lower bound, the July 30 open at $736.05. That is the line in the sand. If we fail to break $742.45 and roll back below $736.05, the bullish structure is invalidated for the session.
The catalyst for this entire move is Amazon. Shares are gapping up 11.5% to $262.55 on news of a $20 billion addition to capital expenditure. Simultaneously, Marvell Technology, MRVL, is up 6.2%, and Micro Power, MPWR, is surging 13.6% on earnings beats. This is validating the AI infrastructure narrative.
The flow data confirms what the tape tells us. The AMZN $20 billion capex ad isn't just news, it's a confirmed order book shift. We're seeing institutional bids hitting the bid side of AMZN and MPWR, locking in supply. Meanwhile, the Apple sell-off is structured. It's not panic, it's algorithmic rebalancing. The Tim Cook era ending is a fundamental shift in valuation models for the index weight, causing quantitative funds to deleverage Apple exposure regardless of the positive press sentiment.
But CIPHER, look at the VIX. It's at 20.66. Smart money is paying premiums for protection. You're talking about order books, but the market is pricing in a recession. The 10-year, 2-year spread is flat at just 45 basis points. Historically, that spread level precedes contraction. We aren't seeing a healthy rotation. We're seeing a last stand bid in tech while the broader economy slows to 1.5% GDP growth.
Let's start with the engine of this market, technology. The technology sector is up 5.5%, carrying the SPY and QQQ higher. Grid, walk us through the technicals on the QQQ break.
QQQ is at $683.55. The immediate hurdle is $685.12, which was the high set on July 30th. Below that we have a support zone around $673.30, the low from yesterday. The key is whether we can hold above $685.12. If we do, we extend the 10-day range, which spans from $661.14 to $710.05. But remember, the IWM is lagging at $292.59 against its high of $292.84. This lack of small-cap participation means the QQQ move is purely index-weighted, not broad-based.
And that's the sentiment problem. The VIX is elevated at 20.66. Normally, when you see a 3% day in QQQ, the VIX compresses below 18. Here, volatility is rising alongside prices. This is a short squeeze dynamic, not organic demand. Traders are covering shorts, not opening new longs. Once those short covers are exhausted, the momentum dies.
Exactly. And look at the macro backdrop. CPI is stuck at 3.46% and core PCE at 3.29%. The Fed funds rate is 3.63%. There is no room for error. The market is pricing in infinite growth via AMZN CAPEX, but GDP is slowing. If the Fed doesn't cut, these valuations become unsustainable. The divergence between the rising equities and the flat yield curve is a trap.
So we have a technical breakout attempt in QQQ, $685.12, that lacks sentiment confirmation, VIX rising, and is backed by a macro contradiction, sticky inflation. The play here is narrow. Long the technology sector is the only viable trade, but it requires strict risk management. Grid, where do we protect that long?
If you're long the technology sector or QQQ, you're watching the $685.12 level. A close below it reverses the intraday bias. For SPY, if we roll off $742.45, we fall back to $736.05. That's the stop-loss reference. Anything below $736.05 is a breakdown of the July 30 open structure.
Now let's talk about the elephant in the room. Apple is down 7.9%. CIPHER, you mentioned flow data. What's happening inside Apple?
The flow is unilateral selling. Institutional algorithms are targeting Apple because the leadership change narrative breaks the certainty model for the biggest index component. Even though news sentiment is positive, plus 0.48, the price action is disconnected. This is a liquidity sink. Sellers are absorbing all bids. Until Apple finds a floor, it drags down the Nasdaq composite weight.
And the retail crowd is confused. They see the positive news articles and try to buy the dip, but the VIX at 20.66 tells us options traders are hedging hard. The put/call ratio is spiking. The sentiment is split. Retail wants to believe, institutions are running. That creates choppy, low-quality volume.
And here's the risk. If Apple continues to bleed, it forces margin calls in leveraged long portfolios. The QQQ rally becomes toxic because the heaviest name is anchoring it down. We could see a scenario where AMZN pumps 11%, but Apple dumps another 5%, leaving QQQ flat or red. The broad tech rally is a mirage if the leader falls.
That's why I'm focusing on the CAPEX winners. MPWR and ETN are showing genuine earnings growth and order book validation. Apple is facing a fundamental structural defect. The market is rotating out of legacy software/aggregators and into physical infrastructure builders. That's the real alpha today.
While tech flies, defensives are crashing. Consumer staples is down 2.16%, the healthcare sector is down 1.64%. SPECTER, you've been warning about a defensive rotation. Are we seeing it?
We are seeing the failure of the defense, which is dangerous. Usually, if the tech rally stalls, money flees to staples or utilities. But consumer staples and the healthcare sector are dropping. Why? Because the VIX is rising. Investors aren't fleeing to safety. They are fleeing to cash or shorting equities. This isn't a healthy rotation. It's a sell everything except the proven AI winners mentality.
Technically, look at consumer staples. It's broken below key support levels. If it continues to drop, it signals that the market has no faith in the economic outlook. The 10-year 2-year spread at 0.45 pp suggests recession risk. If a recession is coming, staples should hold up. The fact that they are falling suggests the market expects a hard landing, not a soft one.
So the conclusion is, tech is riding a short squeeze and a single capex narrative, while defensives are being sold off due to systemic fear, not value investing. The safest position is the leader, the technology sector, with tight stops, while avoiding the laggards until the VIX compresses below 18. To tie this together, Grid flagged the $685.12 resistance in QQQ and the $736.05 support in SPY as the critical technical boundaries. CIPHER highlighted that the rally is fundamentally driven by AMZN $20 billion capex, contrasting it with Apple's structural leadership breakdown. Pulse reminded us that the VIX at 20.66 indicates this is a short covering bounce, not a trend base. SPECTER correctly identified the 10-year 2-year spread of 45 basis points as a looming macro threat that makes this rally fragile. The actionable takeaway is to trade the liquidity wave in the technology sector, but respect the technical ceilings and macro risks.
Key takeaways for the session. Number 1, the S&P 500 is testing $742.45, but volume is thin. Number 2, the rally is narrow, led by AMZN capex news, while Apple struggles with leadership uncertainty. Number 3, the VIX at 20.66 warns us that this move is fragile and prone to reversal. Tomorrow, watch how the market reacts to the Monday open and any weekend news flow regarding the Fed. This is ShadowQuant Equities Edition. Thanks for listening. That wraps up this edition of ShadowQuant Equities. Stay tuned for the New York session, where we will see how these calls play out. Until then, trade safe.